All our regular viewers know one of the most popular segments, I think it's 3 years running now, is Tax Tip Tuesday with Doug Flynn. We used to do it right before taxes. You'd have a little tip for people, a lot of practical stuff that people say, oh, I can use that for my taxes. But this year, as we kind of started off today informally, this is the year where things are a little bit different, right? The refunds, in other words, are a big part of the conversation this year.
Yeah, I think that, people generally do overpay their taxes, and that's why they get a refund. It's really just excess withholding, and they don't adjust during, let's say, life events. I mean, they got married, they had a kid, they got divorced, whatever it is, you have side income, and they're not adjusting. And so those numbers, you pay in too much. I think that's part of it. And so the single biggest thing I can say with this is that tax savings really is not just April 15th. It's year round. And one of the things that is really underutilized is there's a strategic planning tool right on the IRS website. You can Google IRS tax withholding estimator. And this whole point of whether you owe or you get money back, you can go on there and punch in your specific situation. It'll tell you what adjustments you should make to your withholding. And this way, maybe if you owe, you don't owe, or if you're getting back a big refund, in this case, larger than normal, maybe you get some of that throughout the year, which helps you feel better throughout the year, and you can have that money to spend instead of really running tight all year and then getting a big refund. So that's something I would point people to. Almost nobody uses that thing.
No, I like that. Yeah, a little who knew government website that works well for people. Seconds to the closing bell. One more thing. We usually do Tax Tip Tuesdays with you, but with all our Nancy Guthrie coverage yesterday, we didn't get it. So hey, let's call this Tax Tip Wednesday. All right, this is what we were going to talk about. Here it is on screen. This is very helpful for people. Your tips that you give out, and you're looking at stuff that people might be missing, right?
Yeah, this has to do with, most people take the standard deduction because it's high enough over mortgage interest and state and local income taxes. But there are these above the line deductions that don't matter whether you itemize or take the standard deduction. They happen before that and has nothing to do with eligibility, but they're things that people might not think about. Now, you might know about IRA deductions and HSA deductions, but one that people are forgetting are student loan interest deductions. Now, people hadn't paid their student loans because they were deferred for a bit, but now when those came back in, that interest goes above the line, whether you itemize or take the standard. And there are other things for self-employed people and teachers that can take above the line. And the new one for this year is the universal charitable deduction. You won't get it for 25, but in 2026, you get an extra 1,000 as a single or 2,000 as a couple on top of that. Those are above-the-line deductions. Take a look at them. They're even better than the below-the-line deductions.
Glad we play you Wednesday for your tax tip on Tuesday, so that worked out. Thank you, Doug. 90 seconds away, Doug. So let me get tax tips in. It's Tax Tip Tuesday, which Doug brings us this time of year. Been doing it for a few years now, and then we'll get back to the Nancy Guthrie case of those developments. So first screen, let's put it up on the tax tips that Doug has for us. This week, traditional IRA contributions is one of the ones that you're talking about. Roth IRA contributions, HSA contributions as well. And there you go. You can take it from there. So what's the big thing this week?
Yeah, so the thing is that just because the tax year is over doesn't mean that, retirement planning is over, because you do get a grace period. And it's interesting because Congress deliberately allows you until April 15th for these certain deductions if you qualify. And what I would say is when you of course, ask your accountant, or if you're doing it yourself, find out if you do qualify, because it might mean if you put some money away for yourself that you're going to get a tax break. And the thing is, you have to be careful, because when you put an IRA contribution in or any retirement contribution in now between January and April, or between January and October if you're self-employed and using those, the system will default to current year. You have to make sure you're telling them it's for the prior year.
Okay.
And so, yeah, and so that can save you some money on taxes if you qualify, and I think it's really something that people should take a look at, even if they've already taken care of their 401k. Just before you file, is there anything that I can also save? You do get this opportunity to do it. You don't get a lot to do past December 31st. This is one of those that you should definitely look at.
Very good, Doug. We'll leave it there for today. 4 p.m. Another interesting thing, it's Tuesday. We always do the Tax Tip Tuesday with you, which we are going to do in a second, before the closing bell on Wall Street. I heard a theory today with all that's going on that all these tax refunds that people are getting a lot more could be wiped out by what we were just talking about, higher gas prices, things like that. So it all does fit together. We're getting to the point, back to the tablet here for a moment, where we have specifics from Doug on this. So we had about a minute left. Side hustles create side problems. Give us some knowledge.
Right. You need to know about the $400 rule. A lot of people don't realize if you make more than $400 from any side hustle, no matter what it is. And this is whether or not you get a 1099. The IRS doesn't care. Even if it's cash, you need to report it. And once you make more than $1,000 net, you have to also perhaps sign up for quarterly taxes. At the end of the day, there's certain things you can do with this side income to kind of move it down and lower the taxability of it, because you do have to pay both sides of Social Security versus just any employee who just pays the one side of your employee side. You have to pay both sides, or over 15% of self-employment income. But you can do a simplified employee pension plan, that's called a SEP, up until April 15th or up until October 15th if you file an extension. And a quick example is, let's say you owe $2,000 to the federal government. Your accountant might say, hey, listen, if you put $5,000 or $6,000 into your SEP, it might wipe out what you have to pay the government. So would you rather put $5,000 or $6,000 away to you and not give it $2,000 to the government? You might want to look into that.
Thank you, Doug. Right on the money there. 4 p.m. exactly. Doug Flynn on the markets and the closing.
Tax Tip Tuesday. We're coming up on April 15th, of course. But your point is that that date, you know, it's not the end of things.
Yeah, there are some things that you can definitely do right now, and you should do. What you can still do is, if you're eligible for a Roth IRA contribution, you can still do that for prior year, and whether that's a Roth or a traditional would give you a tax deduction if you're eligible for that. And you can also do a health savings account if you have one of those deduction for last year. And the caveat there is that you just have to be really careful to let them know it is for the prior year. When you send contributions in now, the systems are going to default to current year. You have to say this is a prior year. If you're self-employed, you have that SEP contribution you can do for prior year. You can actually do that up until October if you file an extension, which is another thing you could do. You could file an extension if you're not ready to file. But the caveat with that is that doesn't give you an extension of time to pay. It's just an extension of time to file. And some people need that. They want to get it right. So
there's
those
nothing
are things
wrong
you
with
can
doing
still
that,
do.
is there? I saw that you know, an extension could be a quote-unquote smart move at times for certain people, like, because some people have it in their heads, oh, I don't want to do that. I feel like I'm cheating the system, or I'm not, I don't know, I got to get it in on time. Are there situations where extensions make a lot of sense?
Yeah, anytime you might not have all of the tax forms, you're waiting on something, rather than file and then have to refile an amended return, it's better just file an extension. It used to be a whole big thing. You used to have to ask for permission. Now it's an automatic thing if you just file. But then after this date, and that's why it's not just April 15th, you have to think about, what can I do before now and the end of the year? Now, it doesn't help me for last year, but we don't want to let between now and December 31st get away from us. And so you want to, those are the charitable deductions, the tax loss harvesting, and your 401k contributions. Get in as much as you can. You can only do that in the tax year between now and December 31st.
And we got all of that in before the 15th, just barely. Thank you, Doug. Doug Flynn, 4 p.m.